All right, everyone, welcome back. We are pleased to welcome John Davi, CEO and CIO of Astoria Portfolio Advisors. He's an award-winning research strategist and has over 20 years of experience spanning across macro ETF strategy, quantitative research, and portfolio construction. Mr. Davi's research has been recognized and featured on ETF.com, ETFtrends.com, Inside ETFs, Institutional Investor Magazine, and he's a regular contributor to CNBC, Bloomberg, and other media outlets. Mr. Davi was recognized by Bloomberg as an ETF Master Chef. John, thank you so much for being here today. It's all yours.
Thank you for having me so much. And thanks everyone for participating. So I'll just give you kind of a little bit of background about our firm. So we are an investment asset manager. We specialize in putting together strategic ETF portfolios for financial advisors. We have some individuals that come to us direct and invest. Our investment discipline is macro cross asset with a very quantitative approach. It's strategic long-term investing. We currently manage about 1.4 billion. We are the sub-advisor for the PPI, which is the Access Astoria Inflation Sensitive ETF, ticker PPI. So that's a little bit about our firm. And I'm going to walk you through kind of a few slides about kind of how we build portfolios at Astoria. I've got a long history in ETF portfolio construction, going back to 2000. Kind of when we wrote like the ABCs of ETFs. Okay, that's how long I've been kind of working in the ETF ecosphere. So between Morgan Stanley, Merrill Lynch, and at Astoria Advisors, it's a combination of 23 years of research and investment advisory. I've talked a little bit about kind of our philosophy, but it really is kind of like this sweet spot here. If you think about a Venn diagram, it's active management of factor rules-based ETFs, and that's we think that's ideal, is to be active but using like kind of rules-based systematic ETFs, not huge traders, a couple of strategic rebalances a year. We don't, we think right now, let's say, for instance, a lot of the large cap indices, they're dominated by the FANG stocks, and they're very concentrated in a few select stocks. So, we think now more than ever, you want to have active management to kind of navigate, what we think is like a super highly concentrated index in the S&P. So I thought this diagram was important to show. And we have a 5-step program that we're going to kind of walk you through in shortly. But, essentially, this is the program, right? We're looking at valuations, doing like analysis on, okay, where we are in the business cycle, looking at, things like, PE ratio, Cape-Shiller. I mean, valuation isn't the only, determinant. I think right now the business cycle is trumping that. If you think about the business cycle, we've got, credit standards that, I mean, the Fed again yesterday hiked rates, right? I think we're going to see, tighter, kind of lending, credit contract, credit, contraction is going to make the economy weaker. I mean, that's what the Fed does, right? They try and slow the economy down because you have rampant inflation. So this part will, kind of say, okay, now we know where we are in the cycle. We know U.S. valuations are rich, European emerging markets, Japanese equities are cheaper. Maybe you shouldn't be as overweight the US, kind of rotate to the rest of the world. That's kind of step one, is like determining, the strategic asset allocation bands. I think step two is very important, because then people say, okay, I'll just go out and buy, the Vanguard ETF and call it a day. But, step two is like, okay, like now where you want to be in terms of asset allocation, which sectors and countries you want to be tilting towards, away. So let's use a portfolio tool. I think step two is like really Astoria's, kind of true north and true edge, which is like, okay, we're going to take these ETFs and we're going to put it through a portfolio construction tool risk model to know, okay, are we getting that exposure we want? And then step three is just kind of managing, the risk management, understanding, kind of where we are in the cycle, are the portfolios doing what you want them to do? And then should you rebalance? I'll skip through this slide here. So these are some of our offerings. We've got, strategic models, which, we invest with them with a 2-3 year time horizon. That's what we call here dynamic aggressive, dynamic growth. Multi-asset risk strategy, which is a GIPS verified track record that goes back to 2010. I think this one here, is more of like a 1-year time horizon, maybe 18 months, where we can take bigger tracking error per se. And it's more of like a 50 equity and then, 50, kind of bonds and or alts. Our firm does utilize alternatives in order to kind of help with the portfolio risk reduction. And, we're big proponents of that. So largely speaking, 10 to 15 ETFs, it's very concentrated. Sometimes I see advisors in their portfolios, there's 30 ETFs in there. You've got, 5 or 6 that are like sub 1%. We call that the jalapeno effect, where people, just kind of put the jalapeno in just to make it spicy. And, our belief is that everything's gonna kind of, all the ingredients have to like, be copacetic with one another and assimilate. And, so you'll see our portfolios are very, very different. I mentioned the time horizon. So that's a little bit about, the great thing about ETFs is, with the portfolio, with the creation redemption process, you can kind of access good liquidity in the underlying. So if there's an ETF that you don't see a lot of screen liquidity, you can do this creation redemption process in order to circumvent that. So here are kind of like 5 pillars of what we believe in. I mean, this is, again, speaking of the true north, we're very evidence-based. We look at prior cycles, what happened in prior cycles. Let's use that, for the current cycle when we construct the portfolio. We're a sub-advisor, right? So we actually manage the assets. That's different. Some of my peers, what they do is they just put models on platforms and TAMPs, and then those TAMPs trade it. And then, you can't really tax loss harvest. So there's this concept of after-tax returns, right? So tax loss harvesting is something that we're going to do pretty systematically at Astoria after inflation. So the irony of this word after inflation is that we've had this in our investment deck since 2017, when Astoria was started. I mean, people have only thought about, inflation in the last 12 to 18 months, but, it's always a problem in my eyes. I mean, 2% inflation every year, that compounds if you're investing for 10, 20 years, which we're always telling people and advisors, invest for the long run. So, we do use inflation linked assets in order to kind of hedge our inflation risk. And that's frankly what PPI does, the ETF that we sub-advise for. And then risk adjusted returns means that, we're going to use stocks to kind of drive our returns, and then we're going to use bonds to, provide some income, but really to kind of offset some of the equity risk. And then we're going to use alternatives in order to further dampen inside our volatility. So, we want kind of like to protect the left tail and then participate in the upside. So we're global. That's been very controversial the last, 3, 5, 7 years, 10 years, but we do think that there's a place for global equities, Europe, Japan. Mentioned a little bit about this already. Okay, this is a big differentiator for us is, we want to be diversified across factors. So people are all in on growth, and you see, growth worked really well, for a number of years. Then you had value kind of come back with a vengeance last year. It's just better to harvest a portfolio of factors, growth, quality, small cap. The more you can harvest, the smoother your portfolio experience could be. We talked a little bit about portfolio construction tools, and we talked about a systematic tax loss harvest. So that's a little bit about, kind of our investment discipline. We've also got some more tactical models, something we call Renaissance. We do have stock portfolios too. We've had advisors say, look, we like your views, but we just want to ultimately see, 30 high quality stocks. So, in here, what we're doing is, mining for the alpha and the beta, where you take like a large universe of stocks, and then we're going to like screen that out for the factors have the best, metrics, whether it's ROE, ROA, margins, et cetera, et cetera. So that's a big thing of what we do. And here's a little bit about, our quantitative stock portfolio construction process. Obviously, there's some liquidity, market cap thresholds, and then within certain sectors, we may use, forward PE in the case of energy. whereas materials would maybe like price to cash flow. This is all very rules-based, systematic, and again, it fits the profile for those advisors and clients that just want stock portfolios. So let me go down to kind of like the ETF portfolio construction process. I'm just going to go through this deck, and this deck is on astoriaadvisors.com on the investment process section of our website. Okay, so I wrote a blog, about 3 years ago, how to build an ETF model portfolio, and this is what, kind of these next few slides kind of encompass, what that blog has, and vice versa. So, when I think about portfolio construction, and if you think about everything I just said before, really you can distill it to like a 5-step process. So step one is, okay, what's the goal for the client? Are they looking for growth, or are they looking for income? If you want growth, obviously you need to have a lot of stocks, right? If you want income, then you need to lean towards bonds. So that would be like, okay, if you're looking for growth, then we would say somewhere between like 50% equities to like, north of that you'd want to own, and vice versa for bonds. Some people are truly come to us and say, okay, we've got, 10, 20 years to invest, so in that instance, we're not really modeling out like heavy usage of alternatives. Some people like, look, this money's good for 2, 3, 4 years, but I'm very sensitive to downside. So if they're very sensitive to downside, they probably should own more bonds. But as another step, what we do is, including these alternatives. Okay. So step one kind of tells us, how much equity is put in the portfolio. Step two is, we tell the advisor, okay, how much risk can the end client take? Okay. And that's important. Like, are they going to want to just track the S&P or ACWI, MSCI ACWI World plus the Lehman Aggregate Bond Index? Like, or are they going to, how much active risk can we take? What's our track and error? Okay. If you want to be within a tight normal distribution, you got to have a lot of low cost core cheap beta ETFs. If you're willing to kind of utilize our true north, which is like the factor diversification, alternatives, that's going to be 2-3% active risk. But then, we think we can do what we do well, which is to, manage the overall diversification of the portfolios. So step two is really going to tell us like how much, we need to use low cost, ETFs like the Vanguards and the BlackRocks versus like what we'd like, which is like more of like the wisdom tree, kind of like higher active shares. It's going to really tell us whether or not we can utilize, alternative, let's say. Okay, so now we leave away from the advisor, and we say, okay, we know how much risk we can take. We know, what the goal for the client is. So now we go to our portfolio construction process, and we say, okay, where are we in the economic cycle? Where are we in the business cycle? Are we early cycle, mid cycle, late cycle? At Astoria right now, we obviously think we're very late cycle. We think, the economy is clearly slowing. Manufacturing is slowing. You've got a high bar for earnings, right? So I think there's a lot of earnings risk out there. You've got the Fed that's, keeps hiking rates. So that, again, that's going to like, create some issues for, lending, right? And that's what you kind of see with some of these regional banks, right? Where, they can't get their deposits up, right? And then people are taking their money out of the bank to buy T-bills at 5%, which makes, the regional banks even more vulnerable. So this step is important because this we think we do exceptionally well. Then we're going to look at valuations, earnings growth. Is there inflation? Like how much we need to like model for inflation. So step 4 is, okay, now we know kind of where we are in the cycle, how much risk we can take. Historically, what factors have worked well at each stage of the cycle. So right now, late cycle, you want to be large over, let's say, small. You want to be, more defensives over cyclicals. You want to be, kind of longer, higher quality than, let's say, value stocks and or growth stocks. So these are, this is important, right? Because we're not big traders, but, we do think that you need to like strategically tilt, once, twice a year to capture where we are in the cycle. So, we like, factors that have like, decades worth of like empirical evidence saying that they work at that point in the cycle. So, and that's kind of a lot of the research and design that we do. Okay, so step 5 is important. We're going to now load up all our ETFs into a risk tool in order to make sure that we get the desired risk return that we wanted in the portfolio. So that's important. And then, kind of ongoing, we're doing, due diligence, monitoring the portfolio, looking at earnings. I update every week our macro deck book, which kind of highlights, the 3 pillars, which is like, the business cycle, earnings, valuations, and then, sentiment. Okay. So if you go on a Story Advisor's website, there's going to be a tool section. It is password protected. So we just ask you to email us, and you can look at it. But the point is, like, we want to be transparent with people, like, okay, what are our views, what are indicators saying, and then how's our portfolio being positioned. So we think that's pretty rare in this day and age. So that's kind of the bulk of what I was wanted to accomplish, and what I wanted to talk to you all about. Maybe we can take some questions at the moment.
All right, John, thank you so much. We had a question here. They said T. Rowe Price filed for an active capital appreciation ETF managed by the same popular fund manager in March. Do you know when that ETF will be available?
I don't know. There's filings out there. I mean, they're probably in a quiet period, so I don't know how much they're gonna be able to convey to you. But typically I think it's 75 days from when you file to get feedback from the SEC. I know that's a pretty popular fund. I've heard of that mutual fund before. So I'm looking forward to it personally, but I don't have details of like when it's gonna be ready, and when it's gonna be filed. But that whole movement, like out of mutual funds into ETFs, and people, launching kind of complements, like the Fidelity Magellan Fund mutual fund versus like now the ETF, like that's a theme that's fairly common, and I think we're gonna see more and more of.
All right, thank you so much. Another viewer here, they're wondering, do you include sector ETFs to your portfolio?
We don't include sector ETFs in our core risk-based models. I'm going to just show you kind of our offerings. The one model we have that would have sector ETFs is our Renaissance Risk Managed solution, which is benchmarked to the S&P. So when you're benchmarked to the S&P, you're going to go into the sector route. But something like in our standard, 80% equity, 20% bond portfolio, like we're not gonna go into sectors there. For there, we're trying to get into like the big asset classes, like, stocks versus bonds versus commodities versus alternatives. Within stocks, it's more about, do we want to be long US versus emerging markets versus Europe? So that's kind of how we think about, putting sectors in models. So these are our core risk-based models, but they tend to stay at the asset class country level, whereas something like a Renaissance, and we also have what we call inflation sensitive model. Like Renaissance will have things like XLU, XLP, XLV. Those are like the 3 defensive sectors, which we like right now because the business cycle is coming down, and those sectors historically do well in a risk-off environment. Our inflation-sensitive ETF model, that will have tickers like PPI, which is the fund that we sub-advise for, the Inflation Fighter Fund. It'll have other inflation-linked assets in there, things like TIPS, things like global energy, materials, so things like XLE, XLB. It'll also have like things like copper miners, like COPX in there. So we do get into the sector level, but that's for very kind of niche models that we run.
All right, thank you very much. With that being asked, another viewer here, they're wondering, are there niche companies or technologies out there that excite you right now?
There's a good tool called ETF Action where you can go on there and kind of screen out for ETFs and kind of look under the hood. That's a very good tool. WisdomTree is a good tool to kind of, do some like portfolio construction stuff. So that's pretty interesting as well. There's a there's a couple of free tools out there from like Vanguard, which has worked well for us. Morningstar has a good, kind of look under the hood a little bit. So those are the ones that I think, we draw a lot of attention towards.
All right, thank you. Another viewer here, they're wondering, is there anywhere where they can possibly see your track record relative to the indexes, say over the 5 to 10 year period?
Yeah, so if you go to storyadvisors.com and you go to strategies, you'll see all our fact sheets there and how our ETF portfolios have done since then.
All right, thank you. And which active ETFs do you like in these markets?
So I'm just going to show you like the storyadvisors.com fact sheets. I don't know if you see my screen. Does that show up if I share my screen?
Yeah.
Okay. Yeah. So here you'll find all our fact sheets, and if you go to the tools section of our site, it's password protected, so you just got to email me. You'll have like the full risk-based, suite here. So these are all as of the end of March. So you'll see like all our trailing numbers here. This is Sharpe ratio. This is trailing net returns. Okay. Your question was which active ETFs we like. Well, we run an active ETF, PPI. It's the Access Inflation Sensitive ETF. The biggest question we get is like, okay, inflation's coming down. Do we need to be, concerned and utilize, inflation-linked assets and tickers like PPI? And what I would say is that, our view at a story is that inflation, if you look at like the 70s and 80s, inflation was north of 5% for like a 10-year period. Once the genie comes out of the bottle, it's really difficult to, put it back in, right? So I don't think the Fed's going to get to like 2% inflation this year. And they're definitely, kitchen sinking by trying to throw everything at the economy to kind of slow it down. But I don't know about you all, but like where I have gone in this world, I have not paid less for prices. I know homes are mark to mark lower, but I'm in gasoline fine, like that's lower. But any food that I buy, any service that I render, they're all still significantly higher. So I think there's like a dichotomy between like goods and services versus like food inflation versus like, just what like, I mean, the CPI, like the housing is such a big component of that, right? And I understand that like houses are marked down, but that's kind of like paper money at this point, like monopoly money. Like you're not really, kind of feeling that. So our view of the story is that you shouldn't ever time inflation, that you should just kind of have, an allocation. Like, people have car insurance, people have home insurance, they have life insurance. Like we think we've always had inflation insurance at our firm. Like it was centered around gold for many years. And then like after a while, it became clear that like, okay, there's like energy stocks, material stocks, industrial stocks that, I mean, these companies are trading at like 7-8 P ratio. Like our PPI ETF has an 8 P ratio, right? It's like, it's not going to cost you much, right? You're not buying like the S&P or tech stocks, which are like 25 times earnings. Our PPI ETF has like, 8 P ratio, right? So we think that like the bar is lower for these things to fall. And by the way, like, the fund last year was up 4%. The S&P was down, I think 18. And that was very difficult in a very challenging environment. This year, it's down about 2% year to date. And the S&P is up like whatever it is, 7-8%. But, the S&P's return year to date is mostly driven by, those FANG stocks. So I look at like, okay, inflation is obviously, fallen significantly. And the fund is only down 2% year to date. And that's because we're talking about stocks that, have a 7P ratio, like how much lower can it go? Like that type of thing. So I feel like, like that's one active ETF we like. The other ETFs we have in our models, like things like that are more kind of smart beta, like a lot of the WisdomTree ETFs we like, those are like systematic rules based, tilt away from the S&P. Like we're big fans of that. And we envision kind of doing more of that ourselves, and then kind of utilize. I mean, we have the full WisdomTree lineup in our managed portfolios. We just big believers of WisdomTree. So
All right, thank you very much. We had another viewer here. They're asking, does your firm have an ETF alternative to a 60/40 portfolio?
um we would we don't have an ETF that we have per se, but we have this Mars multi-asset risk strategy, which is kind of like kind of like a 50/20, kind of 30 model portfolio. So we utilize a lot of alternatives, about 20% ish, because we really want to like augment our risk return of the portfolio. So here, like most of our portfolios have like what we call like risk reducers, like things that are like inversely correlated. Whereas like in Mars, we can have like risk reducers, but like return enhancers. So instead of like a traditional, equity, which is just, long only, like there may be things like, kind of option override and ETFs within here, where you're getting like equity upside, but you're also getting like quite a bit of coupon. There's also a fair amount of commodities in here, just because we're very bullish on, kind of real assets and commodities, at our firm. So Mars is our complement to like the 60/40 that advisors and retail clients want like evolution on. So, and this is, something that I've been running since 2010. So,
All right, thank you very much. We had another viewer here. I've seen this asked a few times. A hot topic today. They're wondering, is your firm integrating AI into any of your strategies?
well, it's funny, like 23 years ago, I started using FactSet, and they never said like AI or, kind of, I don't know, whatever the latest buzzwords that that you can think of now. But a lot of the stuff that we do, like systematic, quant based, rules based, I mean, there is, heavy amount of technology that we use, like both like, automated and then, physical as well. So, look, I think you still need humans to kind of overlook, the investment process, but we are definitely automating as much as humanly possible. Just because we deal with like, hundreds of thousands of data points, and you can't have like an individual that will sift through that for you. I mean, honestly, like FactSet and some other quant tools do that. But yeah, like the answer is like, yes, we do incorporate that into our investment process.
Thank you very much. A couple of minutes here remain. We had a viewer here. They're saying the price of oil is going down recently. What's your view on commodity and energy ETFs in the next 6 months to a year?
Well, so the economy is clearly slowing, right? So you're gonna have, a downturn in commodities because commodities are cyclical to the global economy. What I would say is that China did reopen, and they're big producers of commodities. I just think we're in a downward trend at the moment that kind of started with, I mean, it started with the Fed, obviously, year and a half ago, but it's hard for you to raise Fed funds by 500 basis points and not have a material impact on the economy, especially when you do 500 basis points in the fastest period, in half a century, which is what they've done when you compare it to other rate hiking cycles. So, I think commodities, look, for 10 years, nobody wanted to own commodities, right? It's only been the last year and a half where, now there's some people that, are say, okay, like maybe we should own commodities because they're cheap. Don't forget oil traded negative, right? The futures were negative, I think like right around COVID, right? Where it was like negative 50. So like it got up to like 120, right? I think, last July, crude oil. Now it's down to like under 70, let's say. So it's a very volatile asset, as you can see from what I just said, like negative 55 to like 120. So I just think you want to just own in your portfolio as part of like your broader inflation strategies. So I think like commodities will still be, I mean, there's just a shortage. Like, we just don't have enough food in this world. And obviously, Ukraine, Russia was a big impact to the food agricultural space. I think like, we want everyone to drive an electric car, but, they need silver, right? So, you could have like this renaissance towards electric vehicles, but you still need commodities to produce these vehicles. battery, lithium. So, I walk away saying like, I think you should own commodities in your portfolio as part of a broad, diversified multi-asset. We have a fair amount of commodities in our PPI ETF. We've got energy equities, we've got physical commodities, we have a little bit of tips. So these are assets nobody wanted to own for 10 years. And I don't think inflation is going to be going away to what the Fed wants it, this year. I think it could take a lot longer. So I would still, the energy equities obviously had huge moves, right? Couple years in a row, big returns. They're still pretty cheap. They're still under owned relative to like the FANG stock. So I just think the next, 3 to 5 years, like you want to own like real assets and things like commodities and energy, natural resource stocks, because you just don't have enough of it in most portfolios.
All right, thank you very much. And for this last question, we have a few seconds here remaining. We had a viewer, they're wondering, is a REIT currently a good asset to hold as an alternative in current market conditions?
What I would say about REITs is like, you can get like, 3.5%, 4% in a normal year, right? I know REITs yielding a lot higher now, but the point is like, okay, if S&P was yielding 2%, REITs will give you 3.5. But, with REITs, if the economy slows, it can go down like 70, 80%, which is what happened in 2000, happened in 2008, happened in 2020. So like REITs to me feels like an income trap, right? If you can get T-bills and take no risk and get like 5.5%. Like, why do you want to buy REITs where you can get like a comparable yield, but if the shoe falls, like it can go down 50%. So some of them, are still down because of COVID and work from home versus the office REITs, and that's a very nuanced area. So I just think there's other better ways to get income in your portfolio.
All right, John, well, brilliant presentation. Thank you for joining us today. We greatly appreciate it.
Absolutely.
All right, everyone, and thank you for watching Money Show's virtual expo for accredited investors. We were just speaking here. John Davi, Astoria Portfolio Advisors. So be sure to visit their website, check them out, be in contact with them. Stick around. We have more great content coming your way.